So we're going to be working on Lamont. So this is the third class activity on pension accounting. So if you didn't watch the first two, go do that, because I'm going to go a little faster on this one, thinking it's your third time and hoping that you've been able to work it on your own and that you're just watching this to check your work. So let's go ahead and get started. We're going to be using this pension worksheet. Of course, there's more than one kind of pension worksheet, and so it doesn't have to be exactly this. It can be a slightly different variation that you like, but it would have these columns in it, and probably all or most of these descriptions on the side. So the beginning balance, there would be no beginning balance in pension expense because expenses and revenues get closed out to retained earnings. But there might be a beginning balance in the two OCI accounts. Let's go see if there is. Okay, we do have a prior service cost, and I don't see a beginning for OCI other gains and losses. They would have to tell us if there is one. And then beginning plan assets, this is the pension plan assets, are there. And then the beginning obligation, and of course that's carrying a credit balance, is $600,000. All right, and so here we have a net liability because the obligations are greater than the assets. And so on the employer's books, a liability for the $190,000 a credit would be reported. Okay, so there's our beginning balances. Now let's go ahead and start building our pension expense for the year. Service cost they gave you, that's the cost of everybody working another year, and so their retirement checks are a little bit bigger because the retirement check formula is years of service times some percent times some average salary. So every time you add a year to that computation because you worked 1 year longer, those checks are all a little bit bigger. So the present value of all those checks got a little bit bigger, and that's this increment. And then the interest cost is based on your beginning obligation times your discount or settlement rate. In this case, it's 10%. And then we can go ahead and finish those entries. The other side of those, so a debit to pension expense for both of those. The other side of that is a credit to the pension asset liability account. And both of those increase the liability, so a credit increases the liability for the pension obligation. All right, and then the actual term increases the plan assets on the pension side of things. And then the pension expense is reduced by the expected or estimated return on assets, which would be the beginning assets times the expected rate of return for assets, which could be a different rate than the discount or settlement rate. In this case, they're both 10%, but they don't have to be the same rate. And so the difference between these two gets spooled up into OCI. You can do this on 2 lines or 1. You can net them into 1, which is perfectly fine. So here they net out to be a $5,000 debit. So there's an unexpected loss of $5,000, and you could have put that in here as $5,000. So the OCI was 0. Now it's a debit of $5,000, and there may or may not be more activity in the OCI during this period. Okay, we're going to amortize some prior service costs. What do they tell us needs to be amortized? And then contributions would be a credit to cash and a debit to the, I probably should finish this before I move on, right? Let's do one thing at a time. And the amortizing of the prior service cost does not impact the pension assets or the pension obligation. When the change in the plan asset contract was made, it increased the liability and the debit went to OCI. And then it was amortized out over the average service life of the pensioners, which could be 20 years or however many years is the average service life of the pensioners. So we don't expense it when we make the change to the plan asset contract. The liability jumps at that time. As soon as you ink that contract, the liability just jumped. But we don't expense it in the year that the liability ballooned from that change in contract. All right, contributions that they made. All right, and the other side of the contributions, of course, is to the asset liability account. And so, get the sign right here. So the assets are bigger because they got some cash from the employer. All right, benefits paid are going to reduce assets and reduce the liability. And a debit reduces the liability, and there's no change to the net assets, and so then there's nothing going on in the employers. Was there a change to assumptions? Yes. All right, so let's increase the liability by that. It could be more clear that this is an increase. It just says changed obligation. It doesn't say increased obligation, so this could be a little bit more clear on that matter, since it can go either way. And that increase gets spooled up into OCI, and as long as OCI doesn't get bigger than that corridor, that 10% of the larger of assets or pension liabilities, then it just sits there and gets offset by other changes in actuarial assumptions or by the difference between actual and expected return on assets, both of which get commingled in this OCI gain or loss account. All right, so there is not going to be any amortization of gain or loss corridor because the beginning is 0. And so the beginning can't possibly be bigger than 10% of the assets or obligations because it's 0. So there's no need to even do that calculation. All right, so now I'm going to do the math and see if it all works out. So I had 2 little errors here I have to fix. Here I had 2 credits, so my journal entry didn't balance. So I have fixed that. And then I pointed at the wrong cell here. I pointed at the year 5 instead of year 4. You probably noticed that and was wondering when I was going to fix that. And now that mystery is over. See how I pointed at the 59 instead of the 40 because I'm busy chatting it up here instead of making... So please fix those on your notes if you didn't already have that fixed. All right, so if you haven't already worked the second year, once you freeze the frame and go ahead and work it, and then come back here and compare what I have with what you got. All right, so now I'm going to get the service cost, and then the interest cost is going to be the beginning obligation times the settlement or discount rate. Finish these entries here, debit to these expense and credit to asset liability account. And then of course the obligation is growing because of 1 year's more service and 1 year closer to retirement. So that increases the obligation. All right, the actual return on assets, which they give us, gets recorded here. And then of course impacts, and I'm going to put it in OCI, and then I'm going to put the expected here and then put that in OCI and let the 2 net. Expected is going to be beginning assets times estimated return on assets. Okay. And so then the difference between the expected and the actual, they're going to net here in the OCI column, or you could make it one line and just put the net there. So that's a net of 4,925 credit. So now we started out with a debit, so that debit's going to be a little bit smaller because of this credit here. So, and that's the idea, I think, with the FASB, is that sometimes there'd be debits, sometimes there'd be credits. They would offset and keep it relatively small. And if it's not small, then we have the corridor test to shave a little bit off and smooth it out over time. All right, let's amortize the prior service costs. What did they tell us to do? There we go. And that amortization of prior service costs increases your pension expense. Contributions, I think there were some. Okay, and there may not be one in every year. Those can be sporadic. And that's going to increase assets. All right, benefits paid. It's going to decrease assets and decrease obligations on the plan side of things. It's not going to change anything on the employer side. They're not involved in paying the pensioners. No change to the net assets. All right, change in assumptions. There were none. Okay, and then amortize corridor. So now we have to do the corridor test. And the corridor test says to take the larger of either the beginning plan assets or the beginning obligations. So here the beginning obligation is bigger, 755,500. Take 10% of that. And then what was the beginning gain or loss for year 5? It's the 92,000. And so that is bigger than the 75.5. So the amount of excess above the corridor of 75 has to be amortized over the useful life. And they tell us the average service life, and they tell us the average service life is 20. So we will be removing 823 of that debit. It's a debit there. Excuse me, it's a debit there, the 92. Well, they're both debits. Okay, so let's amortize that. If that were a credit balance, we would debit to amortize it. Whatever, debit or credit, whatever reduces it. So you could actually have amortization of a gain that decreases pension expense. And in this case, pension expense is going to go up. All right, I'm now going to do the math and see if my math works. So my pension asset mirror accounts are looking good. So my degree, I'm still underfunded, meaning that the assets in the pension are not as high as obligations. And so I've got a net liability on the employer's books, $236,550. All right, so let's do the financial statement amounts that they wanted. The pension expense amount. And then in other comprehensive income, you get the changes to the accumulated other comprehensive income that are in equity. So we report the incremental increase or decrease to these various accounts. So the increment due to unrealized pension gains and losses, be that net, the amortization of the prior service cost, the amortization, and it probably wouldn't be reported as a negative number. Here we're just indicating that it's a credit. So, but on the financial statement itself, the description, the line item description would tell you if it's unrealized gain or unrealized loss, and so you wouldn't need the brackets to reveal that to them. We're not going to have a pension asset, we have a pension liability. And the equity amounts, the accumulated, so the ending balance here in the OCI gain or loss, and then we can also add to this because there would be another balance in accumulated OCI, and that's for the prior service cost. So we want to add that as well to report all the elements that would be all the footprints of your pension activity. Alrighty, so I hope that went well for you, and let me know if there's any questions.